Hey, what's up, guys? This is Marseille, aka the Property Pastor, coming at you one more time. Today, we're going to be bringing you a video walking you through some actual numbers from a deal we recently did here in Newport News. We're going to walk you through what it looks like to consider vacancies, what it looks like to look at your insurance, your taxes, and actually get to a bottom line number of what you would be taking away from a deal. That way, you're kind of doing your work up front. We're also going to talk a little bit about the debt service coverage ratio, which is what your bank cares about in the long run. So I'm looking forward to really jumping into the details of this deal. For those of y'all who are just getting started, deal analysis is a very important step that you got to take when you're evaluating a deal. That's going to tell you what you're going to make, what your bottom line is, and it's really important that we know the score of the game. It's really important that we really dig into the numbers of each deal. Real estate is a kind of a forgiving business in some ways, but they always say you make your money when you buy. I learned that a long time ago, and doing this step is very critical. A bank is going to underwrite your deal, so it's important for you to underwrite your deal even before you try to go. So before we get started, I want to encourage you to like and subscribe to our YouTube page. You can do that just by clicking on the button in the right hand corner. We want you to follow us. We're going to be putting on amazing content to help you in your real estate journey every single week. So with that being said, hey, let's jump into the deal. So first of all, this property was recently purchased. Like I said, it's in the city of Newport News. This is a market where we've got a lot of shipbuilders. We've got a local shipyard not far from actually where this property is located. So it's kind of a very attractive property. So this property is actually a 5-bedroom, 2-bathroom home. And so what we're doing here is we're renting out the individual rooms to tenants. We do that either by the week or we do that by the month. I prefer a monthly tenant because it's a longer term tenant. But if a tenant wants to rent by the week, sometimes the shipyard gets contractors and things like that. They don't want to stay in a hotel, and they'll like to come down our way. So we provide a really nice place to live at a very attractive rate. So we got kind of two rates that we look at. One of them, like I said, being a weekly rate, and the other one being a monthly rate. If people rent from us by the month, we give them a little bit of a discount from a price point to try to keep them as a longer term tenant. That just means that's less work that we got to do as far as turning over the units, as far as keeping up with payments and things like that. So we do all of our payment collections electronically. We don't go and chase checks. We don't go and find cash and all that kind of stuff. None of that's safe. So my property manager, we work together to pretty much send invoices to our tenants and make sure that they are paying either through like a cash app or something to that effect, or actually sending us checks to our PO box. So like I said, we don't chase checks at all, but that's helped a lot with our ability to collect money repeatably and reliably. So let's dig into the numbers. What we got here? So we'll have our screen up so you'll be able to follow along. So basically, the first line of the spreadsheet, this is a spreadsheet that I downloaded from Bigger Pockets and just kind of customize it for my own use. I would encourage you to get used to, a spreadsheet and understand everything that's on there. Some of y'all are like, man, I don't do math that much, but it's not really my thing. I'm not tech savvy, but really things are hard before they're easy. So, this is a great tool, saves you a ton of time. So like I said, I use this deal analyzer, and actually Bigger Pockets has one that if you get a pro membership, it pretty much has it for you. It'll spit out all the numbers and it's very user friendly. So, like I said, there's so many tools out here. That's the wonderful part about it. The big point is find something that works for you, find something that you like. So, back to the spreadsheet. Yeah, the first line we got is our gross scheduled rent income, right? So this particular property, and actually before I jump into that, let me run through the details of the deal: purchase price, what we paid down, closing costs, et cetera, et cetera. So this particular property, we bought it for 141K. We put a down payment of my lender required a 25% down, which is a lot more cash than I really wanted to come out of pocket. But because I knew where the funds were going to be, because I knew where I was going to be looking at from a return on investment, I was willing to go a little bit heavier on the deal. But like I said, we came out of pocket about 35 grand, which is about 25% of a down payment. So that lender is going to typically want you to put down at least 75%. Depending on who you're working with and things like that. So sometimes you can get, 20% down, but on this particular lender, I had to go with 25%. We did get a 30% note. We were able to negotiate our seller paying for the closing costs, which was nice. It was something that we didn't really have to do. We had some repairs that we wanted to do, but basically the seller came back and said, hey, we'll just cover the closing costs. So those were about, I think, about 6 grand. So really our out of pocket was pretty small. I just put in here about $1,000 just to cover anything that came up. So improvement wise, this place was turnkey. I've done a previous video. You can kind of see it. It has stainless steel appliances in it. You know, and if you think about it, if you're renting a room out of a place and they got stainless steel appliances, that's a pretty nice place to stay. So overall, we had to take a loan out for about $106,000, which equated to a mortgage of about $575. So this property is assessed by the city at 155. So that you see our tax rate down here in this column, I mean in this cell rather, and that just kind of funnels over here into the actual monthly expenses. So as you look at what the income of this property is doing, so like I said, we've got 5 rooms, and what we essentially have over here is all of those rooms added up, right? So the first line on our monthly expenses looks at our gross scheduled rent income. So you'll see we got a number of 3,145, which when I ran this deal, it just slapped me in the face and said, do this deal, right? So that kind of breaks down from a 5-bedroom rental perspective. So in one city that we live over in Hampton, you can do 4, a total of the maximum number of tenants you can have in a unit, a single family home basically is 4. But in the city of Newport News, you can do 5, right? So this particular house is huge. It's got like 2,700 square feet, 4 finished bedrooms, and then it's got a huge living area. So we're going to basically wall in that living area and convert it to a 5th bedroom, which, you know, a few $1,000s, we've got another cash flowing room that we can take advantage of. So these numbers are going to kind of reflect that fifth bedroom. So overall, with all 5 bedrooms rented out, we will be looking at $3,145 from a gross scheduled income coming in every month. The next thing we want to look at, though, is we're going to look at vacancies that we're going to run into. So you're going to have turnover in the unit. You're going to have folks that are moving in and out. So basically, I plan for about a 5% vacancy rate. And that equates on this deal to about about $150. So in the course of a year, we expect to see about a 5% vacancy rate between our tenants. So that's going to take our gross scheduled rent income down to a net number of $2,995. So now we're going to start taking out our expenses. You know, there's different calculators out here where you can just do quick math. There's a 50-50 rule that some people use. It basically just says that, hey, after you take all your mortgage, after you take all your expenses out, 50% of your rent you will have at the very end. So that's just a quick calculator, kind of to look at a cash flow perspective. And I'll go into that. We've got that calculator as well as a sanity check. So if you're out there looking at a deal, you know, you want to know really quickly, is this going to work? You know, the 50-50 rule is a really quick, you know, kind of 5-minute estimator to give you a number. But this spreadsheet is going to go into a lot more detail to give you a clear understanding of what we're actually looking at. So some of the expenses that we need to account for are going to be our insurance. You know, you want to put insurance on every single property that you own. It could burn down. You know, hurricanes, floods, you know, all that kind of stuff can happen. In my area, we live by water, so some properties require flood insurance. So that's one of the things I always ask right up front. Because if you got flood insurance, it's gonna, you know, it's gonna add a lot to your insurance costs and knock down your cash flow. This particular property does not require flood insurance, and what we're running into now is that we have, you know, multiple properties and working through the same insurance company. We're starting to get bulk discounts for bringing repeat business, which is nice. So we're spending about $60 a month on our insurance costs. Which is fairly low, but hey, I'm thankful for it. So as you're doing this, you want to kind of get an established relationship with insurance companies. That way, you can just shoot them a quick email and say, "Hey, here's the property, here's the address. Shoot me a policy, shoot me a quick quote, rather, so I can run my numbers." So this one is confirmed at $60 a month, and then you got your taxes. So taxes will come up on this property. Our assessed value, like I mentioned earlier, is $155K. So that gives us a tax rate annually of about $2,000. We add in some of the miscellaneous things, but overall, we're going to be looking at paying about $170 a month on property taxes. One thing that I want to kind of bring back up that I forgot about on the insurance side. You want to plan worst case. So I mentioned in my area, from a flood insurance perspective, if I was required to have flood insurance, it would increase my cost. So as I'm looking at a deal, I want to look at worst case scenario. I want to be conservative, right? So if things ever change and flood insurance was added in later, it would knock my cash flow down. Now, if I'm so tight on my margin that's going to be a deal breaker, then I need to consider that up front and probably walk away from that deal. But back, like I said, the taxes, jumping back to the taxes, we're looking at about $170 a month. Next thing you want to account for is repairs and maintenance. So every property is going to have wear and tear on it. You know, if you presume I'm going to walk into a property and not having issues, you're lying to yourself. You know, you're trying to put lipstick on a pig and make a deal something that's not right. So we typically account for about a 5 to 8% range from an estimating perspective for what our monthly repairs are going to be. This property is in pretty good shape. It's turnkey. Literally, we closed around the 10th of the month, and we moved our first tenant in 2 weeks later. So that's probably the fastest turnaround I've ever had in this business as far as getting a tenant into a unit. So that was pretty cool. But on the repair and maintenance side, we're looking at we estimate about $135 a month. So that equates over to 5% of our overall income. And you see we've got a monthly column and an annualized column. So the other thing that we plan for rather is property management. So I use a property manager. He charges me about 10% a month. And what he does is he answers all the phone calls. He's screening. I mean, that's what I do some of the tenant screening, but I select the final tenants. But he goes and meets with tenants. You know, he gets them to fill out the applications. He fills all the maintenance calls. He coordinates all that stuff. I want to be working on my business and not in my business. You know, some people do self-manage their properties, which that's perfectly fine. And even if you do self-manage, you need to charge yourself 10% because down the road, once your portfolio grows to a certain point, you're probably not going to be, doing the property management aspects yourself. So even in a planning perspective, you may say, hey, I can do great because I'm going to self-manage this property. But if your margin is so tight and requires you to self-manage, that might not be a good deal for you. So again, my property management is 10%. So we're looking at a little bit over $300 a month to pay our property manager. Next thing is utilities. So with this type of property, because we are renting the individual rooms, we cover all the utilities. That's pretty much included in the base rent. You know, we find a lot of tenants who, they're older, they may be retired from the military, they may be on like some kind of disability, things like that. We try to make it as easy as possible for them so that they're not having to go and set up utilities in their name and all that kind of stuff. You know, you may say, some of the concerns are, well, if they don't, care about the utilities, they'll just run it up. They'll leave the water running. They'll, crank the heat up, crank the AC up. So we take some safeguards to try to protect us against those things. You know, we put programmable thermostats and lock those up. Property manager goes in and pretty much resets them every season to a comfortable level. But he's always also making sure that our utility costs are not going way up. So we provide base utilities, also provide cable internet for this particular house. We had so much margin in it, we wanted to make it attractive from an amenity standpoint. So we went ahead and added TV and cable to this particular property. So our utilities combined are a little over $400 a month. And then you got CapEx. You may be saying, what in the world is CapEx? So this is a tool I learned from the folks over at Bigger Pockets. And it's basically saving money, for a rainy day. Right, so what's going to happen in a unit? You're going to have a roof leak. You're going to have an AC unit go out. You're going to have appliances that die and need to be replaced. So CapEx, what that's doing is just kind of keeping you honest and putting money away for capital expenditures. You're always going to have things that come up. And if you haven't planned for them, if you're on your very first deal and you haven't put any CapEx away, you may be putting along for 7-8 months and all of a sudden you have an AC unit go out at $2,000, right? And that kills your year. But if it happens in year number 3 and you've been putting away, 5%, 10% of your money every single month for CapEx, it's just an inconvenience, right? It doesn't feel good, but overall you plan for it. So it's just something that you actually plan for. So we plan for CapEx. My particular CapEx savings on this property is not that big because we got multiple properties in our portfolio. And the reality is that you're not going to most likely have, all your AC units go out. It could happen. But typically in the course of a given year, throughout the course of your portfolio, you'll have a couple of CapEx events. So you don't need to have, 20%, 10%, 20% saved for every single property. If you got kind of that fund set aside that can handle that, then you should be in good shape. So we plan our CapEx kind of low on this property because we've got CapEx sources saved up from other properties. So overall, our total expenses for the month, so we've got about $3,000 coming in, and at this point, our total expenses, just things to operate, the property, to keep it up and running smoothly and efficiently, we're spending about $1,200. So Next thing we want to look at is our net operating income. We want to look at our debt service, et cetera, et cetera. So from a debt service perspective, we got a pretty good rate on this property. It was a little bit, it was around 5%. So overall, our debt service comes out to be $576. That's what we're going to have to pay the mortgage company every month. And people are like, I don't like paying mortgages and all that kind of stuff. Listen, these people who are paying the rent are paying our mortgage. That's the beauty of real estate investing. Some people say, I don't want that risk, right? The beauty of real estate investing is the tenants pay the rent. They pay the mortgage for you, rather. So we're looking at 576 coming out for our first mortgage. So overall, now we've got a number that's going to flesh out of what we're looking at. What are we going to take home every single month? So I mentioned the 50% rule earlier, so I want to just kind of bring attention to that really quickly. So let's say, for example, that we did not have all of the expenses broken down, and we're trying to make a decision quick. I mean, you got a great deal sitting in front of you, or you want to tell them whether or not it's a great deal, and you may have say you're a cash buyer or whatever the case might be, and you want to get to market as fast as possible. Your quick paper napkin analysis would show that you would make about $1,000 a month, right? So from the standpoint of 50% of our rent going towards expenses, what will be left over will be about $1,000 a month. So that's just a quick tool you can use. But I want to also kind of dig into the deeper numbers so that we can actually see what our true bottom line should look like. So this particular model is a little bit different. I think the 50% rule is a little bit it gives you a rough idea. But because, like I mentioned earlier, we are paying utilities, we have a little bit higher expense outlay that we're looking at. That kind of makes the 50% rule a little bit off. But I think if you're doing a single family house or a multi-family house where the tenants pay all the utilities, 50% rule usually turns out to be pretty accurate. So overall, though, it's a really good quick tool. So looking back over here, our final cash flow before taxes. So one thing about it is every one of us has a silent partner in Uncle Sam. The U.S. government is going to get their money. So the thing about it is you want to figure out what you got to pay them and really know what your bottom line is, because that's going to tell you what your deals are going to be doing for you. So I encourage you, as you're looking at deals, to pretty much set what your threshold criteria is. So for me, I don't even like to touch a deal unless I'm going to be bringing in $500 to $600 a month. There's a lot of work that goes into setting up a real estate transaction. If you're dealing with the banks, which is not a lot of fun, it takes a lot. There's a lot of paperwork. There's a lot of diligence steps. So that's one of the reasons why people why they love private money. So I'm just getting started in private money. Matter of fact, just did my first private money deal this week, and I'm so excited about it because it is fast, it's quick. But when you're dealing with the bank, it can be a little bit challenging. So what we're looking at from a cash flow perspective. Right now, before taxes, we are looking at $1,216, which is not bad at all for one transaction deal. When I used to look at single family homes, getting a $200 margin or $300 margin was considered a good deal. So I kind of started focusing more on the multifamily market, which to me is much more lucrative. It's what I like, I enjoy, I understand that model, but it's what works for me. So really, you got to find out what works for you. So really, like I said, we got $1,200 basically coming in before taxes. So we've just thrown a very simple, quick number in here to give us a understanding of what we're going to look like after taxes, which is basically just going to be 30%. And that's going to fluctuate and vary based on the tax bracket you're on. This is a conservative estimate because the wonderful part about real estate investing is that you pay your taxes after expenses, right? Typically, as a W-2 wage earner, you're paying your taxes before expenses, right? So you don't get to deduct any of those expenses. So the wonderful part about real estate is that everything I went over earlier, that insurance, the property management fees, the maintenance fees, all that kind of stuff, we get to deduct from our taxes. So that 30% is really going to get knocked down. Additionally, we got depreciation. So we're going to take this 140K, right, and divide that by 27 and a half years. And every year, we're going to be able to deduct that number from our taxes, which is nice because that's not money you did anything for. So you literally get, it's like a tax credit basically. So Uncle Sam loves real estate investors, and I'm glad they do, you know, and I'm going to take advantage of every tax break that they give us. So, but basically, what our rough estimate, our very conservative estimate for taxes is going to be $365 a month on this property. And you can see over here in this column, column D, is what we're looking at from a yearly perspective. So cash flow after taxes looks like about $850, which is not bad. You know, once it's all said and done, we're going to be bringing home at least an $850 check every single month. So that's pretty good for something that we didn't really work for. So that's pretty amazing. And from an annual perspective, it kind of comes out to be about $10,000. So just want to kind of give you guys another little bit of info down here lower, just for if you're trying to compare one property to another. Some of the areas that we care about as well are the cap rate, net operating income. You know, cap rates typically used primarily in the apartment world or the commercial world, but I like to look at it anyway because it just kind of gives me a standardized look across my different properties in my portfolio. So we're looking at about a cap rate of 15%. A lot of multifamily properties around here are looking somewhere between 8 and 10% and things of that nature. But you know, the other thing we care about is the cash on cash return. So what that's telling us is, okay, this is how much money we spent. What is our cash on cash return for our money, right? So we're looking at this from a before tax standpoint, but we're looking at a 40% cash on cash return, which is nice because that tells us in basically how many years it's going to take us to recoup our original investment. And then at that point, we're solely relying on leverage to bring us a return on our money. So the wonderful thing about real estate is you use leverage, right? We pay 25% down, but we are taking advantage of 100% of that money, or 100% of that asset's ability to bring us money back. So 40% is what it would take, you know, basically looking at that, is what it would take to recoup our money, and which is nice. So we're looking at a 40% cash on cash return. And then the last thing I want to cover, just for your knowledge, is the debt service coverage ratio. And this is an important number to any lender you're going to go to, right? So most lenders want to see a debt service coverage ratio of at least 1.2. And what that's telling you, what that number is basically calculating, is your ability to service the debt based on the income. So in other words, they're going to look at the income that property has coming in, and then the mortgage payment as well, and say, okay, I want a ratio of at least 1.2 to 1.3. I need this property to have, the bank saying I need this property to have at least 30% margin so that they can effectively cover their bills. So this particular property actually has 3.1, so it's in phenomenal shape. I did not have any problems going to a bank and putting a note on this property. You know, so like I said, it was a really nice deal for us. You know, I'm super excited about it. So, you know, like I said, just looking over the numbers, get yourself a calculator similar to this, kind of play around with it. You know, you can, you know, what I did when I started out, I would just, you know, I would go and simulate what I thought that property could make. I kind of put in, based over here in this column, we've got recommended numbers, and then you just get your bottom line. You say, is this property worth my time? You know, and I would encourage you, don't be desperate for a deal. Also, at the same time, don't overanalyze a deal either. So just look at it from the standpoint of, hey, what does it meet my minimum requirements? You know, if my minimum requirements are $500, can I get that? Or my minimum requirements $300, can I get that? You know, if you do those kind of things, you can effectively screen deals, actually, you know, project what your profit is going to be, and do really well. So, you know, I just wanted to run you guys through the numbers of this particular deal. If you want the spreadsheet, I can send it to you. Quick Google search, Bigger Pocket search can find it just as well. But there's a million tools out here, you know, so there's plenty of them to help you succeed. But the important part is actually taking action and doing that work. Hey, look, appreciate you guys tuning in. Can't wait to bring you some more content. Like and subscribe to our YouTube page again, and we're going to keep bringing you great content. Hey, this is the Property Pastor signing off. God bless you guys. Have a great day.